gold has proven to be a valuable commodity throughout history in being a bridge between one thing and another. So as a massive error hedge, that's what gold actually is. As a regular inflation hedge, gold is terrible at that.
Mm.
So if you can handle the volatility and you're thinking, okay, deflationary event, I mean, if ups and downs, I know that what's going to happen over time or over the length of the event, that gold is likely to perform relatively well against most other assets that are likely to get killed outside of safe and liquid assets like U.S. Treasury and things like that. Gold is absolutely a decent. Is absolutely a good idea. It's a hedge thinking forward.
Jeff Snider, the founder of Eurodollar University, recently made an appearance on The Jay Martin Show, where he shared his insights on gold and challenged the common misconceptions surrounding its performance in various economic environments. Snider believes that gold is indeed a valuable asset to hold in a deflationary environment, which goes against the common misconception that it performs well in an inflationary setting. He emphasizes that gold is not an effective hedge against regular inflation, even though supporters of gold may strongly disagree with this notion. Instead, gold's value is more closely tied to significant economic errors that occur in either direction. It serves as a hedge against extreme situations rather than everyday inflation. Throughout history, gold has shown its role as a bridge between different economic conditions. It acts as a safe haven during times of crisis, providing stability and a store of value when other assets may falter. This quality makes gold highly attractive to investors seeking protection during turbulent times. In a low-interest rate environment, such as the one we are currently in, gold is an attractive investment. This is because gold does not pay interest, so there is no opportunity cost to holding it. During the interview, Snider also highlighted the volatility associated with gold, using the example of the 2008 financial crisis. During that period, gold experienced significant price fluctuations. However, when compared to other assets, gold's performance remained relatively stable. Now let's watch excerpts from Jeff Snider's interview with The Jay Martin Show. Be sure to watch the entire video and consider subscribing to our channel. Don't forget to enable post notifications to stay updated on our latest uploads. Thank you and enjoy the video.
In a low interest rate environment, zero interest rate world, gold there's no opportunity cost to holding gold. So I think there's some of the central banks have understand where this system is going, and it's not into a 1970s style secular grade inflation. That there's an attractiveness to owning gold regardless of U.S. Treasuries. I think as the Russians found out the hard way in 2020, the problem with owning gold is it's not liquid. It's not a liquid asset. So it's mostly a portfolio asset that it's non-monetary in nature. So diversifying is more about investment considerations and things like that than it is actually about, hey, we're going to replace the dollar or we're going to replace U.S. Treasuries. It's really just, it's a different form of portfolio assets they can use. And if interest rates go down, then it's, there's no opportunity cost to owning gold. Gold is a terrible inflation hedge. And when you say that, gold proponents they get angry. They get really angry because that's what we've been told forever. But you're right. Think about just an inflationary environment like, the 1980s, which was relatively high rates of consumer price increases throughout the 1980s, but gold went down. You're right. Jay, it's about gold is a hedge against the biggest errors, and the biggest errors in both directions. So gold did really well in the 1970s because we had out of control inflation. Gold did relatively well leading up to the 2008 crisis because we were heading into a bout of deflation. And it continued to do well even after the crisis, even though inflation sort of disappeared. So gold is a hedge against the biggest sort of errors because it makes sense, because you're thinking about owning an asset that could potentially be a bridge between a breakdown in one way or a breakdown in the other way into what comes next. In 2008, for example, which was obviously a deflationary event, gold was incredibly volatile. It went way up and then way down and then way up and then way down. I think it was 3 times up and down. But at the end of the day, or at the end of the crisis, gold was about where it started compared to basically every other asset. That was absolutely terrific performance.
Moving forward, Snider emphasizes the challenges faced by the BRICS nations, such as China, India, and Brazil, regarding the scarcity of U.S. dollars. This scarcity has emerged due to limitations within the Eurodollar system in recent years. In response to this issue, the BRICS nations are actively exploring alternative methods of conducting bilateral and multilateral trade, aiming to reduce their reliance on the US dollar. Snider believes that the pursuit of alternative currencies by the BRICS nations does not indicate a desire to establish a new global currency backed by gold or any other asset. Instead, it represents a pragmatic approach to addressing their significant concerns related to the dollar. Regarding the current situation, Snider asserts that it will not have a significant impact on the global exchange value of the US dollar. Similar to last year, he anticipates that the value of the US dollar will rise. This is because during deflationary crises or banking problems, there is a shortage of US dollars, resulting in a positive exchange value. Let's get back to the interview.
And I think, what the BRICS nations are doing is they're trying their best to survive an environment where dollars are simply scarce. And I know that people have enormous problems when you say that, because they're saying, what do you mean dollars are scarce? The Fed has been printing money since 2009. And that's the truth is the Fed doesn't print money. The Fed creates bank reserves. Real money is not bank reserves. Real money is what the banking system does throughout the Eurodollar environment. And the Eurodollar system has been constricted and constrained for the last 15 years, which causes enormous problems if you need a lot of dollars to engage in international trade, not just international merchandise trade, but also financial trade. So if you're China, who has the world's biggest dollar problem, and you find it difficult to obtain dollars, you start looking at alternative ways to conduct bilateral and sometimes trilateral, multilateral trade, if only to limit the need to use dollars in these international environment, in the international transactions. So the Chinese aren't looking to replace the US dollar. India is not looking to replace the US dollar. Brazil's not looking to replace the US dollar. They're just complaining about the fact that they constantly have to chase after dollars, and it's getting incredibly difficult for them to do so, especially over the last couple of years, the last year or so. So it makes sense that they would try to transact in other currencies as much as they possibly can to limit their needs, to limit their requirement to access the global dollar system, which is incredibly difficult for them to do. That doesn't mean they're trying to recreate the global reserve currency system, because they realize that's not a realistic option for them or really for anyone, because a reserve currency system is incredibly detailed. It's incredibly sophisticated. There's so much logistics behind it that it's not a realistic thing for China, Brazil, or anybody. So what they're really trying to do is limit their dollar problem as best as they can. And if they can transact among common currencies in that limited environment, that's what they're actually going to do. So I don't see gold as sort of there's no impetus here to create a new currency arrangement using gold as the backing for it, as much as they're trying to deal with this massive dollar problem that they have no control over. So it makes sense that they would try to limit their dollar exposures. There's an even bigger issue here. It's not just about the faith behind the reserve currency system. It needs to be available. That's what a reserve currency actually is. What it means is that you can have a country way over here on the other side of the world that has its own custom, its own laws, and its own monetary arrangement. They can easily transact with a country on the other side of the world because there is a common currency in between that is useful in both places that they can intermediate into. So if Norway wants to trade with Japan, they don't have to use, the Japanese don't have to find their way to get kroner in order to pay for Norwegian imports, and the Norwegians don't have to find a use for yen. The US dollar is usable in both of those places, plus it's available in both of those places, which is something the Chinese don't want. They don't want to make yuan available in too many places. I mean, the Chinese yuan offshore market completely died because there was no volume in it. So to create a reserve currency system means you have to have a currency that is available and acceptable in a huge number of places. And the Chinese they don't want to make it available, and most people don't want to transact in yuan for those reasons and others that you just laid out. So no, yuan is not going to be a reserve currency, a real reserve currency anytime soon. As far as what countries are doing to limit their dollar requirements, it really is at the margins here. And it's not going to impact the global the exchange value of the US dollar, which again, I think we're going to see that going higher just like it did last year, because when we see deflationary crisis, when we see banking issues, shortage of US dollars, that's US dollar exchange value positive.
Looking ahead, gold will continue to be regarded as a valuable asset, acting as a hedge against extreme economic situations and providing stability during times of crisis. Its attractiveness as a safe haven, and its ability to retain value makes it highly sought after by investors seeking protection during turbulent times. Furthermore, in a low-interest rate environment, gold's lack of interest payments eliminates the opportunity cost associated with holding it, making it an appealing investment choice. Do you think gold is better protection against extreme economic situations rather than everyday inflation, as suggested by Jeff Snider? Please leave your comments and observations in the comments section below. Also, be sure to like this video, subscribe to the channel, and enable notifications to stay up to date on our latest videos on silver, gold, and copper. Thanks for watching.